Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's edition, we're actually going to be talking about scalping, okay? So we're going to be talking about how to develop a bulletproof scalping mindset, okay? So for most of you who have been trading for, a little bit of time, I'm pretty sure you know that there are different styles of trading, okay? And scalping just happens to be one of those trading styles, okay? So to break it down, to do a quick refresher for the benefit of those who are just a little bit behind, those who are not conversant with the trading styles, let's quickly list them out here, okay? So the trading styles that are popular in the markets, so to say, the first one, you've got scalping, okay? So, which is the one which we are going to be talking about today. But right after scalping, we've got day trading, okay? And I'm going to briefly talk about that, all of them, before we dive into scalping proper, okay? Which is the topic of today's class. So, right after day trading, the third is swing trading, okay? And after swing trading, the fourth is position trading, okay? Position trading. Now, some people tend to consider mechanical trading as a kind of trading style in and of itself. While some people just, regardless of what others choose to classify mechanical trading as, they just, focus on this four, which is more than enough for us to talk about right now, okay? So first things first, what is scalping? Now, to help you understand what scalping is, we'll have to talk about what the other styles of trading are before you'd really appreciate that, okay? So let's first start with position trading before we'll talk about the others, okay? So position trading basically is a trading style where a trader usually tends to approach trading with kind of like an investing mindset. So a position trader is usually a trader who is going to open trades, and usually, on average, those trades are going to last for anywhere between a couple of weeks to a couple of months for those trading positions to be open, okay? So because of that, most times what you'd find is position traders usually tend to focus on finding low risk, high probability trade setups using the higher time frames. So it's not uncommon for a position trader to look at something like the monthly chart as a higher time frame for him to kind of spot trends, okay, and then use time frames like the weekly time frame to look for low risk, high probability trade entry opportunities, okay. So for example, if a position trader was using a simple trend trading approach, okay, so let's not even add any indicators to the chart, let's use pure price action like we usually do with most of the charts, okay. So let's assume this trend trader is just a simple trend trader who uses market structure to identify what direction the market is trending in, okay. So obviously you can see this is the weekly time frame of the British pound against the Japanese yen, okay. Now what you would notice is price on this chart has been consistently making higher highs and higher lows, and when we have higher highs and higher lows being formed on a chart, what does that tell us? That tells us that that particular instrument or that particular chart is experiencing an uptrend, okay, because price is progressively making higher highs and higher lows. It's progressively breaking above its previous highs, which it found difficult to break above, and then it's finding it more and more difficult to break its higher lows, and it keeps running away from them, okay. So for this type of trader, since let's say he did his analysis way back here and he found out that price is consistently breaking higher highs and higher lows, if this was a position trader and he was looking at taking a position in the direction of the trend based off of the weekly time frame, then it would not be uncommon for this trader to find trade entries somewhere around these levels, okay. So if he was using price action to identify when the market was making higher highs and higher lows, and then when he spotted kind of like a high here and waited for a retracement, it would not be uncommon for a trader like this to wait for price to make a pullback and then take a trade in the direction of the trend with a stop loss maybe below this lows, because obviously this is where price is finding it difficult to break, and then aiming for a profit target like the usual trader would do, maybe something like 1:2, 1:3, or whatever the case might be. But the thing I want to draw your attention to is the fact that if I bring the ruler tool up on my charts right now, and assuming this particular trader took an entry somewhere around here, let's say it took him, all of this move, it had to come here to hit his profit target. And this is more than a year or 2 years for this particular trade setup to hit this profit target here, which is just a 1:4 trade or 1:5 trade. Okay, so these trading approaches, they all have their pros and cons. For some position traders, you might look at this and be like, wait, it took this guy almost 2 or 3 years to get a trade just to reach his TP, just a 1:5 TP. I mean, I could trade the lower time frames and, get a 1:5 risk to reward ratio trade like yesterday or whatever the case might be. And all of this is valid. It's just that you need to understand that the trading style you choose to adopt has to align with your trading value, with what you're comfortable with. So for this position trader, it might make sense to him to only look at the charts like maybe once or twice a month or whatever the case might be. And then if you're thinking that he might just have one trading position on this pair, you as a day trader or swing trader or scalper or whatever the case might be focusing solely on trading one currency pair. But for this type of day traders, it's not uncommon for them to look at the charts maybe once or twice a week to identify low risk high probability trade setups, and they might be trading tons of currency pairs. Okay, so they might be trading plenty of currency pairs. So this might just be one of the trades they would take on multiple currency pairs. And just imagine that this trader has a tested and proven trading approach, okay, which nets him more profits on his winning trades than what he loses on average from his losing trades. And let's say he's trading about 20 or 30 currency pairs, for example. So he might easily make up for what you're making on trading the lower time frames by trading more currency pairs and, maybe spending at most a couple of minutes or hours per week on the chart looking for trade setups. Okay, so this depends on what you're comfortable with. It might be that at this moment in your life, you've got a lot of time on your hands. Maybe you don't have a day job. Maybe, your business is not demanding and it doesn't need your attention every single waking hour of the day, okay? So because of that, you might have a lot of time that scalping or day trading, which we're going to talk about in a bit, is actually making sense to you because you've got the time to sit in front of the charts and, look for low risk high probability trade setup, take those trades and manage those trades properly without, affecting your life or anything like that. So it all boils down to how you're comfortable with the trading style you choose to use. Okay, so we've talked about position trading, and I've given you an example that most times position traders tend to look at the higher time frame charts to identify trade opportunities. It's not uncommon for a position trader to look for trade setups based on the daily time frame or the weekly time frame or even the monthly time frame, and then when he takes those trades, it's not uncommon for him to have those trades open for months at a time. That's completely normal. Okay, now apart from this, the second trading style which we're going to be talking about is known as swing trading. Now swing trading is not as it's not as extreme as position trading in the whole times of the trades that it opens. So for example, it's not uncommon for you to have swing traders who are trading based off of the 4-hour chart or the 1-hour chart or whatever the case might be. But the thing with swing trading is that most times the trades that you're going to have open, most of the times they are going to last anywhere from a couple of days to a couple of weeks at most, and those trades usually would come to their end. So it's not uncommon for, again, using the simple trading strategy example that we used for the position size trade, for the position trader, the swing trader could also use the same trading approach where he uses market structure to identify the direction of the trend. And in this case, you'd notice that price has been making higher highs and higher lows, higher highs and higher lows. So, for example, for this particular swing trader, he might say that, okay, you know what, since price is making higher highs and higher lows and we have what looks to be a retracement on this chart, when the retracement comes to an end, I'm probably going to take a trade in the direction of the trend. And so when the retracement comes to an end, he's probably going to, after spotting a bullish engulfing or whatever the case might be, based on his trading plan, take a trade where he's having a stop loss, risking 1% of his account, and aiming to make 1:4 or 1:5. Now, I want you to focus on the difference here. This is just a different trading approach from positions trading, okay? But with swing trading, you can notice that if he had entered a trade here with a stop loss here and aiming for the same 1:4 or 1:5 that the position trader was aiming for, you can see that when I pick the ruler tool here, it took this trade from here to here, which is about just over a month. So let's say maybe 2 or 3 weeks or 4 weeks, okay? Just about 4 to 4.5 weeks, 4 to 5 weeks, okay, for this trade to hit its profit target. Now, compare that with the position example, which we noted for the position trader, who had an open trade, which was, to hit a 1:4 or 1:5, that took almost 3 or 4 years for that particular trading position to hit its profit target. Okay, and this is because position trading, like I told you, requires the least amount of time that a trader needs to, analyze the charts, look for trade setups, place those trades, and manage those trades, and all of that. So this might appeal to a certain type of trader who wants to get involved with trading, but maybe on a part-time basis. He doesn't have the time to, constantly look at the charts and what the chart is doing, placing a trade, managing the trades, moving the stops to break even, doing all those things, because maybe he's a busy person. Maybe he's got other businesses, a job to attend to, a family to fend for, and all of those things, okay? While for a swing trader, it could be the same thing, but a swing trader actually has a little more time to dedicate to the market, to dedicate to his trading craft than the positions trader does, okay? So the swing trader, since he's going to be trading time frames like the 4-hour time frame, or the 1-hour time frame, or the 2-hour time frame, or whatever the case might be, then he actually is going to need to spend a little more time than the position trader looking for trade setups and placing those trades and managing those trades. But he's not going to spend as little time as a position trader would do, and that's actually a pro for the position trader. But the con is that for the position trader, it might take a long time for one of his trades to hit either their stop losses or their profit target, but the trade holding time for a swing trader is much less than that of the position trader on average. So even though it might take the position trader anywhere from a couple of months or a couple of years for the trades they take to hit their profit targets or stop losses, with the swing trader, usually it's going to be, he's going to have his trades hit their profit targets or their stop losses within a couple of weeks. At most, maybe a month or a little over a month. But it's going to be it's going to be faster than it will take for his position trader to have his trades hit either his stop losses or his profit targets. Okay? Now we're going to move on to the second criteria, the second trading style, which is day trading. Day trading is very much different than swing trading, because the idea behind day trading is that a trader is usually going to open a trade at the beginning of a trading day or the beginning of a trading session. And the logic is that at the end of that trading session, whatever open trades that trader has must be closed. So let me give you an example. Let's assume that I'm trading the London session, okay? The idea behind day trading is that when the London session begins, whatever the case might be, I should have that trade open at the beginning of the session or anywhere close to the beginning of the session. But when it's close to the end of the session or the end of the session, I should be flat. That trading position needs to be closed. Okay? That trading position needs to be closed. So in this case, let me quickly try to add this onto the 1-hour time frame and see if it's going to show me the sessions. Okay? Let me see. Very good. Okay? So when I do this, let me go to the 15 minutes time frame so that hopefully we're going to get very good. We're going to get a clear example. Okay, now we're coming close to the meat and potatoes of this particular class, which is about scalping. Okay, so for a day trader, you can see that this boxes that we have here, the blue one is where it started was the beginning of London session, and where it ended. Okay, this box is the end of London session. You can see that throughout this London session, the lowest price that price was able to come to was the low of the box here, and the highest price that price was able to reach during that London session was the high of this box around here. Now, for a day trader, it's not uncommon, based on his trading strategy or his methodology for identifying low risk, high probability trade setups, for him to actually take, let's say, for example, a buy trade. I'm just using this as an example, okay? So I'm obviously picking a trade example that actually worked, okay? So it's not uncommon for a day trader to have a trade somewhere around here when the market made this low, and then to close that trade somewhere around here when the session ended. So he might immediately, the session opens based on the criteria he chooses to actually open a trade or close a trade. He might open the trade here, and at the close of the session, close that trade. And the same thing can apply for another session here. For like the New York session, for example, he might open a trade at the beginning of the session, close the trade at the end of the session. The idea behind day trading that I want you guys to have at the back of your minds is that for a day trader, usually his trades are not going to last more than a particular trading session. A trading day, okay? It could extend from, the London session to up onto the New York session, but it's not going to last more than a 24-hour period of a trading day. That's day trading in a nutshell. Now, right after day trading comes what we're talking about in today's class. And okay, before I wrap up, I just remembered that usually you're going to find that day traders look for their trade setups based on time frames like, the 15 minutes time frame or the 5 minutes time frame. Okay, usually that's the kind of time frames that day traders tend to use for identifying their trading opportunities. And because of this, you'd notice that since they're trading these lower time frames, they need to be in front of their charts or very alert for when they are going to get trade setups on the charts. Because the idea is, just think about it. Assuming a trader was a day trader, for example, and he was about to trade the New York session, when price made this high and it made this double top, for example, and it closed with this bearish engulfing candlestick, assuming based on this particular trader's trading methodology, after seeing this double top and after seeing that price is making lower lows and lower highs, he wants to take a trade in the direction of the downtrend, since price is making lower lows and lower highs after the formation of this bearish engulfing candlestick. Now, this is the 5 minutes time frame. If, for example, this particular day trader, when this candlestick closed, he wasn't in front of his computer, or maybe he was in the bathroom, or maybe he was having lunch, or whatever the case might be, and he happened to miss this chart, then this price would have easily gone without him. Because the idea I want you to know is that when you're trading the lower time frames, it's going to be much more time dependent on you. So you need to be in front of the charts more. You need to be very active, very vigilant to what is happening on the charts. You need to act fast so that you don't miss your trading opportunities. Now, for a trader who is trading something like the 4-hour time frame or the daily time frame, by the time this might close, it might take a couple of hours before he would even react to it, and he would still not miss the trade. But for somebody who is trading maybe based off of the 5 minutes time frame or the 15 minutes time frame, by the time these setups are fully formed, if he's not in front of the charts by that particular time, if he's trading manually, obviously, then he wouldn't be able to take advantage of these opportunities. And so that could result in a lot of missed trade setups. Okay? So again, you need to weigh the pros and cons. Are you a busy person? Do you have a regular job that you attend to and you want to trade Forex on a part-time basis? Then if you are that person, scalping and day trading might not be for you, because it's time dependent. It's very time dependent, and if you can't devote that time to be in front of your computer to look for those trade setups or picking your phone or whatever the case might be, then that trading style is not for you. You can trade as a swing trader or position trader. Position trader is a bit extreme, so you can trade like a swing trader or whatever the case might be, and that would be more than enough for you. Because for a swing trader, basically, you might just look at the charts maybe once or twice or 3 times a day and, look for trade setups, and that is it. Okay? Now, last but not the least is scalping. I need to draw your attention before we talk about this, okay? You see, for most of the other trading styles that we talked about, usually the trader would be interested in catching a huge chunk of the move. So, to give you an example, remember I told you that if, for example, based on this trader's trading strategy, he uses a couple of chart patterns to identify trade setups and market structure, whatever the case might be. Okay? And so this particular day trader, for example, at the beginning of the trading day, he looked at the charts and he was looking for, what the market might offer to him at that particular day. And then somewhere during the session, he found out that, okay, price is making lower lows and lower highs based on the price action on the 5-minute time frame of this chart. And so when price formed this bearish engulfing candlestick right at the top of this, this double top, he might say, okay, you know what? At the close of this candle, I'm taking a short trade here with a stop loss above here, because for whatever reason price was able to break above this high, then it's no longer a double top, and I want to cut my losses and go out. It's not uncommon for day traders to aim for risk to reward ratios which are positive in nature, meaning, for example, you're risking 1 to make 3, or you're risking 1 to make 2. What I mean by you're risking 1 is whatever the multiple that you're risking. If you're risking 1% of your account capital on each trade you take, then when you're aiming to make 3, then you want to make 3 times what you're risking on that trade. So if you're risking 1%, you want to make 3%. If you're risking 2%, you want to make 6%, and so it continues. Okay. The reason why most traders trade with this positive risk to reward ratio is because if they're risking a fixed amount and they're losing only a small amount on every trade that they take, while the profits they make on each trade they win is like 2 times or 3 times what they're risking on average, then even if they lost more trades than they won, within reason of course, they are going to end up being profitable. For scalpers, it's a bit different, because usually for scalpers, their mindset, remember, this is what we're talking about. This is the title of today's topic, okay? Having the mindset of a scalping trader, okay? For scalpers, most of the times, they're not looking to catch the entirety of a move or the huge chunk of a move. Most times, what scalpers are looking to do is they want to identify where the momentum in the market is, and then usually they just want to enter into a trade quickly with huge lot sizes, and then quickly take 1 or 2, 3 pips off of the table, and that's it. They do this a couple of times in a day, and they call it a day. They take their trades and they're out. So, for example, it's not uncommon for a scalper to say, you know what, it looks like the momentum for today is through the downside. And so as a result of this, I'm going to risk maybe, 50 pips. And I want to only make something like 10 pips, for example. So he would enter here, risking all of this, and then immediately that price just moves in his favor. He just cashes out what he gets and he's out. If he sees there's still potential for that move, he cashes out and he's out. So he's trading with a negative risk to reward ratio. It's not uncommon for scalpers to do that, because the reason why most scalpers trade like this is because they're trading with very, very large lot sizes. Because the idea is they just want to catch 1 or 2 or 3 pips, and then when they do that, because they're trading with so huge lot sizes, the profits from their trades are going to be significant enough to make a living off of. But the downside to scalping, which you need to prepare your mind for, is that it's not also uncommon for a scalper to have a very high win rate, but if he's not properly managing his risk, to not even make any money at the end of the day, because he's trading with a negative risk to reward ratio. Remember, when we were explaining trading with positive risk to reward ratio, the major selling point was that because your losing trades are capped, and then whenever you take a trade, you're aiming to make maybe 2 or 3 times what you're risking on average. Even if you lost more trades than you won, at the end of the day, if you took a large sample size of trades, you could end up being profitable. But scalpers are actually doing the opposite. And so even if a scalper has a win rate like 80% or 90%, if he's not careful, and if he's not practicing proper risk management with discipline, because what he's risking on average is much larger than what he's aiming for, then just a couple of losses would wipe out all of the profits that he would get from the trades that he won. So if you want to choose scalping as a trading style that you want to use to trade the markets, you need to also factor in the stress that comes with it. Not only do you need to devote a lot of time to looking at the charts and being in front of the computer, placing the trades, being super sharp and managing the trades the way you need to and all of that, but you also need to have it at the back of your mind that if you're trading as a scalper with a negative risk to reward ratio, then it's not uncommon for you to have a very high win rate but have nothing to show for it if you don't practice proper risk management. This doesn't mean that there are no scalpers out there who trade with positive risk to reward ratios, but the idea is that the majority of scalpers usually don't even trade with a stop loss. they'll, identify where the momentum is in the market, and before you know it, they'll just place a trade in the direction of that momentum, hoping to just catch, a couple of very little pips because they're trading with large lot sizes. But where the danger comes in is if for a scalper, for example, let's say that for this particular trading day, he sees that the momentum is to the downside. And so let's say he's been taking trades successfully, hitting his profit targets and all of this. But then when he took his last trade somewhere around here, aiming to just make, 2, 3, or 4 pips or whatever the case might be, price never reached this level. And so now price is reversing. So it's not uncommon for a scalper, if price was to make it all the way up here, all the profits that he made when he was scalping the markets and the price was moving down here, for him to lose it with just this one single losing trade, if he's not careful enough. Okay? So you need to have this at the back of your mind, so that if you want to approach scalping, you need to know that there's time investment involved, and there's also the psychological investment can also be tasking, because if you don't have the proper mindset, seeing that you've taken like 4 or 5 trades that are giving you profits and giving you, you're so happy about those winning trades, and just seeing one single losing trade wipe out all of the profits from those trades is not something that is, very easy for somebody to adjust to. So weigh the pros and cons. If you're more comfortable, with, investing a little bit of time with trading and, not having it take all of your life or whatever the case might be, then maybe look at swing trading or day trading or whatever the case might be. But if you know the pros and cons of scalping and you're still okay with going with it, then just know that you need to do it properly. And you can even choose to scalp with a strategy without going for a negative risk to reward ratio. So you might be a scalper who just, every time you're taking a trade, maybe you're risking 5 or 10 pips and you're aiming for a 1:2 risk to reward ratio, or whatever the case might be. It's just that in this case, you're technically not scalping, because you're not just going for, quick 2, 3, 4, or 5 pips, whatever the case might be. Because now you're aiming for much more than you're risking, which is good, proper risk management. But also, it's not like the traditional scalping where you just enter into a trade and quickly, close the trade when you're in profits or whatever the case might be, okay? So with this, we've pretty much come to the end of this week's edition of the ITU Forex class, and I sincerely hope that you got value in it as much as I had a good time giving you this value and this knowledge that we've come across, okay? But before we round up the class, I would also like to use this opportunity to let you guys know about our trading bots, okay? Because, again, we just talked about how scalping is time intensive. You need to be in front of your charts and, glued to the screen or whatever the case might be for you to identify low risk, high probability trade setups, place those trades, and do all of those things, okay? But when you're trading with our bots, you don't need to do all of that. You could have a scalping bot, which is going to be placing those trades for you, identifying the setups, and doing the proper risk management and all of that without you having to lift a finger after you set everything up. So if you're interested in earning while you're learning by using a couple of bots that we offer on part of your portfolio, then please reach out to us on the socials or drop a comment in the comment section, and we'll be more than happy to assist you guys with the step-by-step setup on how to set everything up, okay? So I look forward to seeing you guys in next week's edition of the ITU Forex class. And again, have a wonderful rest of your trading week. I wish you the very best of luck. God bless you. Go out there and crush the markets. Thank you, and thank you.